Welcome to Macro Monday on Investec Focus Radio SA, a podcast about what's driving global and local markets. I'm Chris Holdsworth, Chief Investment Strategist at Investec Wealth and Investment. Every Monday morning, I'll update you on key developments from the past week and what you need to know about the week ahead. If you'd prefer to watch a video with the graphs and charts I referred to in the podcast, just go to investec.com/Macro Monday. This week, we're going to have a look at a couple of interest rate decisions. We'll look at the Fed, which cut, and the SARB, which decided not to. We'll have a look at consumer confidence in the US and a wide array of forecasts for growth in Q3. And finally, we'll have a look at consumer confidence in Europe as well. We're going to start off with the Fed. Last week, the FOMC cut rates by 25 bips, as was widely expected. There are a couple of interesting points in the announcement. As a starting point, the Fed increased its forecast for both growth and inflation next year. They're now roughly in line with consensus. But it's interesting nonetheless that a central bank is cutting rates while increasing its forecast for both growth and inflation. That's pretty unusual. And if you look at inflation forecasts over the past couple of meetings, there has been the steady increase in the distribution of inflation forecasts from FOMC meetings. The distribution of forecasts in March was a lot lower than the distribution in June, which was lower than the distribution in September. So the Fed has become increasingly concerned around inflation next year. But they cut anyway. And the reason they cut was because of concerns around the labor market. We've seen a range of indicators, the non-farm payrolls number, the initial jobless claims numbers, suggesting that the US labor market is slowing. And Jerome Powell indicated quite clearly that he's less comfortable with the state of the labor market in the US now than he was before. And as a result, even though inflation is likely to be ahead of target next year, the FOMC was willing to cut. Now, the market is expecting much more. At this point, the market is pricing in a further 4 cuts over the coming year. And there is an interesting disconnect developing between what's currently priced into interest rates and what's currently priced into the equity market. The interest rate market, in effect, is expecting the Fed to have to cut quite aggressively over the coming year, presumably because of a fear that growth is going to be weak, the labor market is going to be weak, even though inflation remains elevated. So the Fed, in effect, will be forced to cut because of a weak growth environment. That's not what's reflected in the S&P 500. On a forward multiple of 23.5 times, the equity market seems to be pricing quite a buoyant economic environment. So either the equity market is going to be right, in which case the Fed doesn't need to cut by as much, or the interest rate market's correct, in which case the US equity market is trading on a very elevated multiple. But it does, as I say, at this point to an interesting disconnect between what's currently priced in the equity market and the short end of the yield curve in the US. Switching to consumer sentiment in the US, we have seen a range of indicators suggest that consumer sentiment is decreasing. But even so, retail sales remain strong. And I suspect part of what's happening here is that we've got increasing concentration of spending at the top end. The top 10% of income earners in the US now account for 50% of consumer spend. So these sentiment surveys, which give a broad view of the man or woman on the street, are going to be less relevant for consumption because what matters most is the top end. And at this point in the US, the top end is doing very well, partly due to wealth effects, partly due to wage increases. And our focus when attempting to figure out where retail sales is going to go should be on the top end because of its significance for retail spend in the US. So where do we sit at the moment for Q3 growth? Well, there's a very wide array of forecasts for Q3 GDP growth at this point, even though we're getting close to the end of the quarter. If you look at the consensus forecast from Bloomberg, the current consensus estimates that the US economy is growing by about 1.5%. If you look at the Atlanta Fed GDP Now estimate, which is a high-frequency estimate based on the latest data, that suggests growth is running at over 3%. And if you look at the St. Louis Fed estimate, that number is currently around 0. And it's unusual for such a wide array of forecasts to be in place. And it suggests that there's a lot of uncertainty at this point with regards to the US economy. And it's not difficult to have some sympathy for the Fed. I mean, if at this point it's difficult to estimate where growth currently is, you can imagine it's very difficult to try to estimate where growth is going to be in 12 months' time. And because of that elevated uncertainty, we can expect them to be cautious, and that does suggest that the market might be pricing in a bit too much with regards to rate cuts from the Fed over the coming 12 months. Switching to Europe, just like in the US, we've seen a decline in consumer confidence, and we'd expect in time that likely to be reflected in weaker consumer spend. It is important to note that at this point in time, if that Atlanta Fed GDP Now estimate of 3% in the US economy is right, then the US economy is growing much more rapidly than the European economy. And the reason that's significant is that a lot of the recent dollar weakness, we believe, has come about due to concerns around the performance of the US economy relative to other developed markets. And if, in fact, the US economy is going to continue to grow strongly at 3% or above, we would expect that would be associated with dollar strength. Now, it is important to note that's not our base case. We don't expect the dollar to strengthen materially. Our base case is that the dollar will continue to weaken, but we're likely to be wrong on that if the US economy does actually continue to grow at about 3% or so. And as mentioned before, there's a huge amount of uncertainty around that. Switching to SA, South African inflation surprised on the downside last week, coming out at 3.3% versus a consensus of 3.5%. It's quite a meaningful surprise on the downside. Even so, inflation is still likely to increase from this point through to year end. We see inflation at about 4% by year end, picking up to 4.3% in Jan. And that, I think, is the primary reason why the SARB did not cut last week, even though the Fed had cut and South African inflation had surprised on the downside, and inflation expectations in South Africa had declined, and nominal GDP growth rate in South Africa is below 3%. Despite all of that, the SARB decided to keep rates elevated in South Africa. I think that's because they're looking to get inflation down to 3%. They're looking to get inflation expectations down to 3%, even before they've got formal sign-off on that from Treasury. So that's their framework. We shouldn't expect much from them in terms of rate cuts. Maybe we can get one more by year end, given that the Fed had cuts, but we shouldn't be penciling in a too aggressive set of cuts from the SARB until we see inflation and inflation expectations closer to 3%. The net result of that is that real rates in SA are high and will likely remain high, and the SARB is likely to be a headwind for growth in SA for the foreseeable future. And that's where we're going to end it for this week.
That's all for this episode. Do tune in next week for more investment insights from me, Chris Holdsworth, and the Investec Wealth and Investment team. If you haven't yet added us to your podcast feed, you can subscribe to Investec Focus Radio SA wherever you listen. And please take a minute to rate our podcast so we can surface this content to the broader investment community. If you want to see the graphs that I reference in the podcast, you can watch a video version of this recording at investec.com/Macro Monday.
The views expressed are those of the contributors at the time of publication and do not necessarily represent the views of Investec Wealth and Investment International and should not be taken as advice, guidance, or recommendation. Investec Wealth and Investment International, a member of the JSE Equity, Equity Derivatives, Currency Derivatives, Bond Derivatives, and Interest Rate Derivatives markets, an authorized financial services provider and a registered credit provider.